Today, we will talk about the allowance for doubtful accounts. An allowance for doubtful accounts is a contra account that nets against the total receivables presented on the balance sheet to reflect only the amounts expected to be paid. The allowance for doubtful accounts estimates the percentage of accounts receivable that are expected to be uncollectible. However, the actual payment behavior of customers may differ substantially from the estimate. Regardless of company policies and procedures for credit collections, the risk of the failure to receive payment is always present in a transaction utilizing credit. Thus, a company is required to realize this risk through the establishment of the allowance for doubtful accounts and offsetting bad debt expense. In accordance with the matching principle of accounting, this ensures that expenses related to the sale are recorded in the same accounting period as the revenue is earned. The allowance for doubtful accounts also helps companies more accurately estimate the actual value of their account receivables. Two primary methods exist for estimating the dollar amount of accounts receivables not expected to be collected. The sales method applies a flat percentage to the total dollar amount of sales for the period, while the accounts receivable aging method groups outstanding accounts receivable by age and applies specific percentages to each group. Companies can also use risk classification, historical percentage, Pareto analysis, or specific identification methods to determine the estimate. The first step in accounting for the allowance for doubtful accounts is to establish the allowance. This is done by using one of the estimation methods to predict what proportion of accounts receivable will go uncollected. The allowance account is presented on the balance sheet with other assets, but it is a contra asset that reduces the balance of total assets. The allowance for doubtful accounts is a general ledger account that is used to estimate the amount of accounts receivable that will not be collected. A company uses this account to record how many accounts receivable it thinks will be lost. The balance may be estimated using several different methods, and management should periodically evaluate the balance of the allowance account to ensure the appropriate bad debt expense and net accounts receivables are being recorded. Here are 5 key takeaways. 1. The allowance for doubtful accounts is a contra account that records the percentage of receivables expected to be uncollectible, though companies may specifically trace accounts. 2. The allowance is established in the same accounting period as the original sale, with an offset to bad debt expense. 3. The percentage of sales method and the accounts receivable aging method are the two most common ways to estimate uncollectible accounts. 4. Companies can also use specific identification, historical evidence, and/or risk assignment to determine the estimate. 5. The purpose of the allowance is to use the matching principle between revenue and expenses while also reporting the net amount of assets using the conservatism principle. Hope this would help. Thanks for watching.